March 2023. Credit Suisse faces collapse. Switzerland's second-largest bank. One of the world's most respected financial institutions. 167 years of history. Disintegrating in real time. Emergency weekend talks. Swiss government officials. Banking regulators. UBS executives. The decision? Force a takeover before markets open Monday. By Sunday night, Credit Suisse no longer exists as an independent bank. Absorbed by UBS in a government-brokered rescue. A global banking giant. Erased in days. But here's what makes this different from every other bank collapse. This wasn't sudden. This wasn't a liquidity crisis that caught everyone off guard. This was a decade-long loss of credibility that finally turned fatal. This is the story of how one of the world's most trusted banks destroyed its own reputation, one scandal at a time, until trust vanished completely. And in banking, once trust is gone, nothing else matters. Credit Suisse didn't start as reckless. Founded in 1856 to finance Switzerland's railway system, it grew into one of Europe's most prestigious banks. By the late 20th century, Credit Suisse was synonymous with Swiss banking itself. Wealth management, private banking, discretion, stability, conservatism. The bank managed money for some of the world's wealthiest individuals. European aristocracy, Middle Eastern royalty, corporate executives, entrepreneurs. Credit Suisse didn't just hold money. It sold something more valuable: trust. Clients believed their assets were safe, that the bank would protect their interests, that Swiss banking meant absolute reliability. This reputation allowed Credit Suisse to charge premium fees, to attract deposits others couldn't, to operate globally with a seal of approval that few institutions possessed. Too Swiss to fail. That reputation was built over more than a century, and it would take just a decade to destroy it completely. After the 2008 financial crisis, the banking world changed. Regulations tightened, capital requirements increased, traditional banking became less profitable. Credit Suisse faced pressure. Shareholders wanted returns. Competitors were expanding. American banks were dominating investment banking. So, Credit Suisse shifted. It expanded its investment banking operations, took on riskier clients, chased higher margin deals. The logic seemed sound. Swiss private banking was stable but low growth. Investment banking offered bigger profits. But this created a tension. Credit Suisse's reputation was built on conservatism, on being the safe choice, the reliable institution that didn't take unnecessary risks. Now it was competing with Goldman Sachs and JP Morgan, playing in markets where risk was the currency. The bank's culture began changing, faster than anyone outside realized. Risk tolerance quietly increased. Compliance became an obstacle to overcome rather than a discipline to follow. Senior executives pushed for growth. Bonuses rewarded revenue. Questions about risk were dismissed. One former Credit Suisse executive later described the shift. "We stopped asking, 'Should we do this?' and started asking, 'Can we do this legally?'" The bank changed, but its reputation didn't, yet. Clients still believed Credit Suisse was the cautious Swiss institution it had always been. That gap between perception and reality would prove fatal. The first cracks appeared in the 2010s. 2012, Credit Suisse settles with US authorities over helping Americans evade taxes, pays $2.6 billion in fines. 2014, the bank pleads guilty to criminal charges for the tax evasion scheme. One of the first major banks to face criminal prosecution. 2017, Credit Suisse is fined for money laundering related to a Bulgarian crime ring. The bank admits to spying on its own executives. Surveillance scandals, private investigators hired to follow senior staff. One by one, scandals pile up. None catastrophic on its own, but together they form a pattern. Compliance failures, regulatory breaches, ethical lapses. Executives resign. Some are fired. Regulators issue warnings. But Credit Suisse keeps operating. Markets keep trusting it. Clients keep depositing money. Because the reputation still holds. For now. Swiss banking. Stability. Discretion. The brand carries the institution through each scandal. But reputations are like credit. You can draw on them for a while, but eventually the balance runs out. And Credit Suisse was burning through its credibility faster than anyone realized. March 2021. Greensill Capital collapses. Most people had never heard of Greensill. It was a supply chain finance company. It provided short-term loans to businesses waiting for customer payments. Credit Suisse had partnered with Greensill, created investment funds that bought Greensill's loans, sold these funds to wealth management clients as safe, steady returns. Over $10 billion in client money was invested. When Greensill collapsed, the funds froze. Clients couldn't access their money. The problem wasn't just the losses. It was who the clients were. Wealthy individuals, family offices, people who'd trusted Credit Suisse with their fortunes. These weren't retail investors who'd bought into risky products. These were private banking clients who'd been told the investments were conservative. The fury was immediate. Clients demanded explanations. How had Credit Suisse invested their money in a collapsing supply chain lender? Credit Suisse's response was inadequate. The bank admitted failures in due diligence, apologized, promised reforms. But the damage was done. Wealth management clients began questioning everything. If Credit Suisse got Greensill wrong, what else might be wrong? Trust, once absolute, became conditional. And in private banking, conditional trust is worthless. March 2021. The same month as Greensill, Archegos Capital Management implodes. Archegos was a family office, run by Bill Huang, a former hedge fund manager. It invested aggressively in tech and media stocks, using massive leverage. Credit Suisse was one of Archegos' prime brokers. It lent Huang billions through total return swaps. These swaps allowed Huang to control huge positions without actually owning the stocks. Credit Suisse held the shares. Huang just bet on price movements. The leverage was extreme. Huang controlled positions worth over $100 billion with just a few billion in capital. When the stocks started falling, Archegos couldn't meet margin calls. The positions collapsed. Credit Suisse lost $5.5 billion, one of the largest losses in banking history. But the loss itself wasn't the worst part. The worst part was that Credit Suisse had no idea how exposed it was. The bank's risk management had completely failed. It didn't understand the concentration, didn't see the leverage building, didn't coordinate across divisions. Other banks that lent to Archegos got out earlier. Goldman Sachs, Morgan Stanley. They saw the risk and cut exposure. Credit Suisse kept lending, right up until the collapse. The bank's CEO at the time, Thomas Gottstein, admitted we clearly had issues with our risk management. Clients and investors heard that statement differently. They heard, "We don't know what we're doing." After Greensill and Archegos, something fundamental broke. Clients started withdrawing money, not all at once, but steadily. Wealth management outflows accelerated, billions leaving every quarter. These weren't panicked retail depositors. These were sophisticated clients making calculated decisions. They no longer believed Credit Suisse would protect their assets. The bank's share price collapsed, from over 13 Swiss francs in early 2021 to under 4 francs by late 2022. Credit rating agencies downgraded Credit Suisse. Bond yields spiked. The cost of borrowing increased. Leadership reshuffled constantly. New CEOs appointed. New strategies announced. None of it mattered, because the problem wasn't strategy. It was credibility. Banks survive on confidence, on the belief that they're solvent, competent, trustworthy. Once that belief cracks, the numbers stop mattering. Credit Suisse still had assets, still had capital. On paper, it was solvent. But markets didn't believe the paper anymore. And in modern banking, belief is everything. Late 2022 into early 2023, Credit Suisse announces another capital raise. Needs to shore up its balance sheet, reassure markets. Saudi National Bank, Credit Suisse's largest shareholder, is asked if it will invest more. The answer? Absolutely not. Markets panic. If Credit Suisse's biggest backer won't put in more money, why should anyone else? Deposits start fleeing. Not slowly, fast. In the fourth quarter of 2022 alone, Credit Suisse loses 110 billion Swiss francs in deposits, over $120 billion. The outflows accelerate in early 2023. Clients pull money out of wealth management accounts. Corporations move cash to other banks. Institutional investors withdraw. It's a classic bank run, modern version. No lines outside branches, just digital transfers. Billions moving with a few keystrokes. Credit Suisse tries to stop it, offers higher interest rates, reassures clients. Senior executives give media interviews insisting the bank is stable. None of it works, because a bank run isn't about fundamentals. It's about fear. And once fear starts, it feeds on itself. By mid-March 2023, Credit Suisse is burning through liquidity. The Swiss National Bank provides emergency funding, 50 billion francs. It's not enough. The bleeding continues. Solvency didn't kill Credit Suisse. Confidence did. March the 17th to 19th, 2023. Emergency weekend talks. Swiss government officials, banking regulators, Swiss National Bank, UBS executives. The message is clear. Credit Suisse cannot open for business Monday without a solution. If it collapses, the contagion could spread. Switzerland's financial system could destabilize. Global markets could panic. UBS is pressured to buy Credit Suisse. UBS doesn't want to. The risks are enormous. Credit Suisse's problems are deep. Integrating two massive banks would be a nightmare. But the Swiss government makes an offer UBS can't refuse. 3 billion Swiss francs. That's what UBS will pay. A fraction of what Credit Suisse was worth just 2 years earlier. The government provides guarantees, covers potential losses up to 9 billion francs. offers liquidity support. And then comes the controversial part. Credit Suisse's AT1 bonds are wiped out. 16 billion francs worth. Gone. AT1 bonds are additional Tier 1 capital, a type of debt that's supposed to absorb losses in a crisis. But they're senior to equity. In a normal bankruptcy, bondholders get paid before shareholders. In this deal, shareholders get something. Bondholders get nothing. The decision shocks global markets. AT1 bonds were supposed to be safer than equity. Now they're worthless, while shareholders received UBS shares. The Swiss regulator justifies it. Emergency measures, necessary to protect the system. But the precedent is set. Rules can change overnight when regulators decide it's necessary. By Sunday night, the deal is done. Credit Suisse is absorbed into UBS. A 167-year-old institution, gone. The Credit Suisse collapse sends shockwaves globally. AT1 bonds across Europe and the US get repriced. Yields spike. Investors demand higher returns to compensate for the new risk they've just learned exists. Billions in value evaporate from bank balance sheets. Questions erupt about bank regulation. How did regulators miss Credit Suisse's problems? Why wasn't this caught earlier? The Swiss regulator, FINMA, faces intense criticism. It had oversight. It saw the scandals. It issued warnings. But it didn't force action early enough. By the time intervention came, only a rescue could work. Trust in safe European banks wobbles. If Credit Suisse could collapse, what about others? Deutsche Bank faces pressure. Share price drops. Executives rush to reassure markets. Other mid-sized banks face scrutiny. Are there more Credit Suisses hiding in plain sight? The collapse proves a fundamental truth about modern banking. Size doesn't guarantee survival. Reputation doesn't guarantee survival. Only confidence does. And confidence, once lost, is almost impossible to rebuild. Credit Suisse's collapse teaches several lessons. First, culture eats capital. Credit Suisse had capital. It met regulatory requirements. On paper, it was solvent. But the culture was broken. Risk management failed repeatedly. Scandals piled up. Executives prioritized short-term gains over long-term stability. Capital couldn't save a bank that had lost its way. Second, reputational banking is fragile. Credit Suisse's entire business model relied on trust. Clients believed their money was safe, that the bank was competent. Once that belief cracked, the business model collapsed. No amount of restructuring could fix it, because the product being sold was confidence itself. Third, complexity hides risk. Credit Suisse's problems weren't obvious from the outside. The bank was complex. Operations spread globally. Risk buried in derivatives. Supply chain finance. Leveraged loans. Until Greensill and Archegos exposed how much the bank didn't understand about its own positions. Fourth, regulation can't replace discipline. Credit Suisse was regulated, supervised, required to hold capital and report risks. But regulations are backward-looking. They address past crises. They can't catch every new risk. Discipline has to come from within, from a culture that values prudence over profit. Credit Suisse lost that discipline. Fifth, confidence is the real balance sheet. Banks are built on belief. The belief that deposits are safe, that the institution is solvent, that management knows what it's doing. When that belief disappears, balance sheets become irrelevant. Credit Suisse had assets, but when clients stopped believing, those assets couldn't be liquidated fast enough to stop the run. In modern finance, survival isn't about size. It's about credibility and how fast it can disappear. Credit Suisse didn't run out of money first. It ran out of belief. Greensill, Archegos, scandals, losses, each one chipped away at the bank's reputation. For a while, the reputation held. The brand carried the institution. But reputations are finite resources. Once exhausted, they can't be replenished quickly enough. By March 2023, clients, investors, and markets had stopped believing Credit Suisse could manage risk. And once that belief was gone, rescue became inevitable. The forced takeover erased 167 years of history. Thousands of employees lost jobs. Shareholders lost fortunes. Bondholders lost everything. But the real loss was credibility. Credit Suisse proved that even the most established institutions can collapse when trust evaporates. In modern finance, survival isn't about how much capital you have. It's about how much people believe in you. And belief can disappear faster than anyone expects.